Joining me today on this replay. We had the flashing screen yesterday, so we're going to do it again today. Stock Index Portfolio Webinar for 2020. Excited for 2020, and we'll go over the different things such as the market environment and the strategies we're going to use. We're going to look at the strategies from 2019. So excited about this. Thank you for joining me. This is a data-based, data experience-based webinar, and it's a culmination of 22 years of doing this. So let's go ahead and get started. I'm David Beane. I'm the owner of Capstone Trading Systems, a system development company, a trading system development company. I started developing strategies in 1997, 2 years out of college, while working as an engineer in telecom, as wireless telecom. And so first I worked on daily bars with Super Charts, which was a TradeStation product back then. And then I moved to intraday bars in 1998 with a TradeStation. They had a desktop version of TradeStation that you had to purchase separately. It was about, I guess, about $3,000 to purchase the product. You had to purchase the historical data from someone else. You had to purchase the live data from another provider, and then manually execute your trades. I still remember the blue Lind Waldock screen that I entered trades in to get started. So quite different now. Everything's integrated into one, so it's nice to have that. The costs are much less, and more people are doing this. So I finally went full-time in January of 2001 and have been a trader and developer ever since. I spent a lot of time studying the markets. It's fun for me. It doesn't feel like work to me because I love solving the market. So I spend a lot of time doing it though. So take notes, whatever device you have, but also a replay will be available. We will start with some basic definitions and education. Is there a lot of bad information and hype in the industry? And I want to give you some perspective. We also start with a discussion on volatility and on risk. Also want to talk about why you are here today. So one of the reasons that maybe you are here today, maybe it rings true. So you prefer to manage your strategy yourself and are less interested in buy and hold passive strategies. Maybe you are new to trading and want to learn how to trade using trading systems. Maybe you're looking for strategy ideas. Maybe you have some ideas of your own. Maybe you've already developed some strategies and you want to add to those as well. So you want to increase your strategy list, your diversification. That's definitely one way to do it. Maybe you want to learn about portfolio setups. We're certainly going to go into that towards the end of the webinar, so have a chance to learn how we set up portfolios after many years of doing this, some of the tricks of the trade. So how do we manage volatility? Markets are fundamentally volatile. No way around it. Your problem is not in the math. There is no math to get you out of having to experience uncertainty. Ed Seykata, one of the market wizards, if you haven't read the book Market Wizards by Jack Schwager, highly encourage that reading. So basically what he's saying is I see a lot of people spending a lot of time trying to perfect their trading system to avoid volatility, but there's normal volatility in the markets and normal volatility in your account, and eventually your trading system will probably experience more volatility in the future than it has in the past as markets change. And so we will talk about that. We'll talk about the discretion to systematic discretion in this webinar. So it's normal to have consecutive losers, to be stopped out at lows for longs and to be stopped out at highs for shorts when you're in a losing streak. You don't want that to occur all the time, but that's normal in trading if you go through periods of that. If losing $5,000 sounds more painful than you can bear, then futures trading is not for you. When I say losing, I'm talking about normal drawdowns, even when trading one or two contracts. So that's typical volatility when trading these fixed future-sized contracts. Now, with the advent of the micros, you can reduce that volatility somewhat, especially while you learn. Encourage you, if you're just getting started, to trade small. A lot of people make mistakes one way or the other, blow out their account. With the micros, you can blow out small accounts like $1,000 instead of a $10,000 account just to learn. So it's part of the learning experience. So I'm just talking about discretionary trading when I'm talking about blowing out your account or technical errors. So the John Cena tweet talked about how on the last webinar I ran into a kid at the sporting goods store, told me I look like John Cena. So I looked him up, didn't know much about him. He's a WWE wrestler. He's been interviewed on CNBC, so he has some nice quotes on his tweets, some motivational quotes. And if you never take a chance, you may never fail, but you also may never succeed at anything. Expect staying right where you are. So you can bring some sports psychology into trading somewhat, but there is some differences between sports and between trading. For example, in sports, when you're down, you fight hard to get back. In trading, oftentimes when you're down, you reduce your risk, you take a break, and so you kind of give up. You kind of give up for in the short term. You have a quitter's mindset in the short term when you're down, and it's considered, it feels kind of weak, and it's the opposite of what we're taught in our academic backgrounds, in our sporting backgrounds, to bear down and fight harder. And so you weather the storm in trading by trading smaller or stopping until you back in sync. And so that's part of the difference. But some of the similarities between sports and trading are there, but then there's differences. So you don't want to get into revenge trading and fight the markets when things aren't going your way. If a strategy is struggling, maybe you need to back off and redo the research on it. So I want to reword this quote for traders. If you never take a trade, you'll never have a losing trade or drawdown, but you will never experience trading profits either. So this is intuitively obvious, and we understand this intellectually. We have to remind ourselves of this emotionally. If you have a strategy that wins 50% of the time and the winners are 2 times bigger than the losers, are your losing trades bad trades? Is this a bad day? If so, every other half of your days are going to be bad, and you don't want to have bad days. You just have losing days. Those are part of the expectation when you trade, when you go through trading. So these are some things to think about when you're trading. So you have to be honest with yourself about the risks you're willing to take. And so, back to the John Cena quote, maybe you're happy with where you are. Expect staying right where you are. Maybe if you're happy where you are and you don't want to fail and you don't want to take risks, entrepreneurial endeavors or trading may not be for you. So most of you are on the webinar today because you're willing to experience some risk for opportunity. And here is the standard risk. Your financial advisor may tell you not to participate in short-term trading or active asset management. So we're going to discuss futures trading today, and I'll make sure you understand the risks involved. Be sure to read through that. The problem with what most people do is they don't define their risk, or once they define it, maybe they are not okay with what they originally defined. They didn't know themselves, or maybe they use too much leverage. So oftentimes it's better to trade smaller than what you originally think you should. Maybe think about your risk and then cut it in half. So that's one way to think about it. So be sure to read through this for a little bit longer, and then I'm going to go to the next slide. So do you trust Wall Street? I don't trust Wall Street, basically from the mindset of passive investment, turn your head, buy and hold. And so not talking about the people or the exchanges per se, just the overall mindset of just passively turning a blind eye. Most of you on the webinar today are probably like me. You want to take some control over what's happening. So this is in the discussion on taking all your long-term investments and moving them to an active trading account. Even with the best tools and strategies, your decisions could cause greater losses. So you want to use risk capital when you do this and diversify yourself. So over the past 10 years, passive investments have done so well, it's easy to fall in this recency bias mode and think will always be this easy. Right now, it's been hard to imagine any sort of bear market. Any news event, positive or negative, tends to drive the market higher. And so bear markets, very few see it coming. In 1929, the stock market had a 90% correction. In 2008, there was a 50% plus correction. And history can and will repeat itself. And I hope for a prosperous economy, country and world, but it's pullbacks happen, and they've happened in the past, and they will happen in the future at some point. So even though the financial engineering exists, there will be more volatility in passive investments too, is what I'm trying to say. And so for years, active asset management hedge funds were highly esteemed, but in the last 10 years, the pendulum has swung so that passive is highly esteemed. And so I think that at some point we'll swing back, and what we do is very diverse. It provides you with diversity from just passive investing. Jeffrey Gunlock, the bond king, he's not always right, but he has pretty good rationale and insight. So during the next bear market, we won't recover for another 20 years. He's basically looking at some cycles in Japan, Europe, and emerging markets. We know that in the 1929 crash, it took about 25 years to recover. And so I'm not trying to present a doom and gloom scenario, but one of opportunity, one of balance. I like to keep a balanced mindset. I like to focus on the truth and what could happen without being pessimistic or overly optimistic. So who is the best hedge fund trader of all of time, and what was his investment style? We talked about this on the previous webinar as well. Jim Simons from Renaissance Technology Medallion Fund. You don't hear much about him. He is an algorithmic trader. He has an algorithmic trading hedge fund called the Medallion Fund, and definitely ahead of the guys that you hear about most: George Soros, Warren Buffett, Ray Dalio. The average annual return over 30 years was 66% before fees and 39% after fees. He got started in the 1970s. He did well at first, lost a lot of investors when his original fund went through a 40% drawdown, and then he refined his approach before he went through this 30-year streak of 66% annual returns. And he stopped taking money at about $10 billion, and he himself is a billionaire. He started out in academia, was a code breaker for the NSA, had some big setbacks before those returns. So, he didn't really get started with the latest fund until his late 40s, almost 50. So, and his investment style was algorithmic system trading. So why trading systems? So imagine this approach. Imagine you are in LA. You don't know anybody in LA. You've never been to LA, and if you've been to LA, you know that this is a very large city, a lot of traffic, very hard to get around efficiently. It's not efficient to move around in LA. And what if you were given an address, let's say 101, let's say we said Pine Street yesterday. Well, let's go with that again today. 101 Pine Street. Something that you couldn't really, if it was Ocean Street, you could maybe go look near the ocean. But the most efficient way, if you get off the airport, get a rental car, and your task is to find 101 Pine Street, GPS. Punch it in your GPS, you'll get there the quickest. That's number one. Number two, you could use a map. When I first moved to Dallas in the mid-90s, they had the Maps Goes, and we used maps. That was before GPS. So it was not bad. So you can get around okay, not as efficient as a GPS, but okay with the Maps Go. And number three, you could ask for directions. In a city like as big as LA, there's going to be probably a lot of residents that don't know where 101 Pine Street is. So it's going to take you some time. It might take you all day, a week, I don't know. Ask. Or you could just drive around until you found it. I mean, you might never find it. It might take you a month, it might take you a year. Just drive around and all by yourself, never asking anybody. And maybe it'll take you 20 years or 5 years or 10 years or a year. I don't know. I don't have any idea how long that would take. I would hate to have the task of driving around in LA and looking for an obscure street number. So the reason I bring this up is to say that trading systems are similar to that. It enables us to define our risk, and it gives us an opportunity to seek alpha. It's a versatile for different portfolio allocations. So if you want to trade different markets, but the main thing I see when you have a trading system is it gives you a path. That should be a point that I write down. Let's say number 4, it's a roadmap. Roadmap to know where you are. Maybe if you have a discretionary trading strategy, you have three losers in a row, you're down a couple of thousand, and you say, you know, this strategy doesn't work, but maybe that's normal. Maybe it's normal for your strategy, discretionary trading strategy, to go through the losing streak it's going through. You just don't know it because you don't have a roadmap, you don't have a trading system, you don't have a performance report of what to expect. So it's a very vague path. So everyone wants to beat the market, and having a trading system is the best way I've found. Jim Simons found that as well, and it just serves as a roadmap. So that's why we look at trading systems. So what is algorithmic system trading? Trading systems. If you're new to trading, you're new to trading systems. I'll explain this here. It's a set of rules to determine when you should enter and when to exit trades. You can come up with a set of rules, you can back test them, you can see how well they did in the past, and anticipate if they would do in the future if your assumptions are reasonable, or if you're just data mining and you have biases that would not work into the future. So example, if it's Monday, buy, if it's Friday, sell, that might work well in a bull market. So you have to make sure you're in a bull market. If you're in a bear market, that may not work. So if you anticipate being in a bull market, that strategy works. You continue to trade that and know what to expect. It won't always work, and when it doesn't work, you would know why, for how long it might not work. And so here's a Ninja Trader 8 market replay example that I want to show you. Just an automated, it's a market replay. The speed on this is increased, so we don't sit here all day and watch a multi-hour trade while we're on the webinar. So this video does not work, so I'm going to bring it up in the media player, and I'm going to play this for you.
Order pending. Order canceled.
So that's an example of an automated trading system in action. And most of you may have used, probably have already used automated trading systems, so you know that. But if you haven't, that's just an example of a trading system. Well, it works now. So here is another one, and if you stay with me, I'm going to show you the actually show you the open code for this strategy at the end of the webinar. I developed this in this time frame right here, and it's had a nice out of sample performance as this bull market has strengthened. So you see this nice equity curve the last 14 months. It's long only, E-mini S&P after hours, no slippage or commission, and it's the last 14 months. The average trade profit is 117. The drawdown is only 1450. And again, I'm going to show you this at the end of the webinar, the exact code for this in the question and answer session. So this is the type of equity curve we all like to see, but we want to see as little pain as possible. But no system, I want to show you the main point here is that no system works this well all the time. So you have this, I developed it here, and it had this out of sample performance, and it does well from this time frame, but it does go through this rough period from here till about here. So it made a little equity peak there, then dropped. And so this isn't bad either. So you could probably use a money management algorithm, equity curve algorithm to fix this. But you see the average trade profit is kind of small, 23.91. This is without slippage and commission. This is the last 10 years, and it's only 3 lines of code. So you can probably improve this strategy with coding, adding an additional rule, or working with the money management algorithms to improve this strategy. So the main point is that no strategy works all the time. So we have a portfolio of strategies so that the ones that are working overcome the ones that are not working. So again, we all seek this very little pain or drawdown and this time period. And so the problem is that you can get caught up in your development and creating strategies with biases. And we'll go over that as well in a little bit, and why we've chosen a portfolio instead of trying to make a perfect strategy. So what if we have a long list of these strategies? You can develop a portfolio of trading systems, and that's what we have done. It's simply a group of strategies trading all at the same time. You can combine these strategies to seek diversity. Like I said, when one strategy is working, the other may not be, and so you want your strategies that are working to outperform those that are not working. So this is where we get the term algorithmic trading systems portfolio. It's just algorithmic trading systems, a lot of them combined together in a portfolio. So ugly equity curves combined is another way to think about it. All trading systems with slippage and commission are choppy. Like Ed Sekata said, the only way to avoid volatility in trading is to not trade. You're going to have volatility in trading, and all good strategies have volatilities. They have setbacks. They have 1 to 2 year drawdowns in an individual strategy, and no one wants to just sit through 1 to 2 year drawdown trading one strategy or trying to develop a perfect strategy that avoids that. So you can find a long list of ugly equity curves right here. They're good strategies and they work at different times, but they're overall ugly equity curves. When you back test them, we're back testing to November of 1997 for the ES. That's over 20 years. And we're back testing to 2001. That's the data that I have, and the ES and NQ. And so these are not just strategies that work, you know, we're not just looking at a biased window of 2 to 3 years. We're looking at, you know, 22 years, 18 years on these. So that's a long time to look at these. This is actually some equity curves from the 200K portfolio. But when you combine all these down here, you sum them up, you get this equity curve, and it still has drawdowns. This equity curve still has drawdowns. It looks a lot nicer, but there is no straight line equity curve. That still includes some drawdowns. So let's look over some key concepts and some frameworks to understand. So there's a great deal of misunderstanding and expectations, and we have, you know, different types of people on this webinar, different audience. Maybe you're a beginner, less than 2 years, intermediate, somewhere between 2 and 10, or maybe you're seasoned, 10 to 20 or more. And so I want to go over these. There's 3 styles, 3 types of trading styles. There's 100% discretionary, and that's where a lot of people start. 100% systematic, and then there's systematic discretion is where you get to and where we are today and where the portfolios land. Believe it or not, the portfolios land in this systematic discretion. So if you're 100% discretionary, this is sort of show up and trade by the seat of the pants approach. Maybe you see some videos or some indicators and use technical analysis and isolation and look at chart patterns and you just trade it. Maybe you saw some cherry pick trades that look good, and so you just trade it like that, and maybe it works for a while, maybe it loses, but it's not consistent. Maybe you don't find any consistency. If after years of trading, maybe you could potentially find some success using some discretion, but probably you're using some sort of method too that you know about. Fundamental analysis, isolated, maybe you're trading economic or corporate news. When you don't really know how to test your strategy ideas but have knowledge in these categories, maybe you're a discretionary trader, and so maybe you have some good ideas, you just don't know how to manage it because you don't know what to make of the losing streaks. And so you try to transition to systematics. You try to figure out, does your idea actually work? So this is where most system traders are, is they learn to test their ideas to see if they're actually good and how much pain they should go through when they're going through a losing streak. So you seek to develop a strategy that works forever, can be one of the flaws of 100% systematic. I know I started there. You want to develop a strategy. You hope it never hits a worst case drawdown, and you just hope the market doesn't change. And it's not a powerful position to be in. You perceive worst case drawdowns as depressing stop points. Just not a powerful position to be in. You have to anticipate these things happening and have a strategy for it. Continued search for a better and better strategy that will work forever. So you just continue chasing this perfect strategy, the holy grail of sorts. You don't admit to chasing the holy grail because you don't expect it to be 100% perfect, but you expect it to be better than is possible. So that's kind of a beginner's mindset for systematic trading, and then you have to anticipate being a discretionary systematic trader. So ultimately, there is no 100% systematic approach. Systems trading is ultimately discretionary. The manager still has to decide how much risk to accept, which markets to play, and how aggressively to increase and decrease the trading base as a function of equity change. So this is Ed Sekata again. favorite market wizard, and he is started back in the 70s, and so he has some great things to say about this that make a lot of sense. So in systematic discretion, you realize your strategy will have a worst case drawdown at some point. Realize the opportunity in drawdowns. Drawdowns can provide opportunity. You can help you see market changes. You can see new market patterns that are developing, and you can recover from those drawdowns if you approach it from a position of power instead of a position of weakness, hoping that it does not happen. You could use money management, equity curve, algorithm approaches. We have the money management algorithms as well. And there's cycles of drawdown, there's cycles of volatility, there's cycles of days of the week. And so, so there's a difference between discretion and systematic discretion. So I typically, you know, this is what the portfolio is really based on, is we have a set of strategies for all the different types of market patterns, market environments that we've seen in the past, and some of them have big drawdowns at some point, but you can wrap a strategy with a big drawdown in with a lot of other strategies that do well while it's doing poorly in that drawdown, and you're not stuck to one idea. You're not stuck on one idea working all the time. So that's why I like this approach. And it also gives you the chance, if you're trading 30 strategies, each strategy is kind of like a module. If one just needs to go away, you can take that one strategy out. It's only 1/30th of the whole portfolio, and so one strategy could really weigh a portfolio down if it trades a lot. So you have to monitor that, and think about the market environment for which it was developed, and that's what we do on our side. And so you have the benefit of systematic discretion. It's not just the systems, but the systematic discretion, because you get the updates throughout the year based on the market environment. You get the experience that goes along with that. Systematic discretion, another quote from Ed Seykota from Market Wizards: the trading rules I live by are to cut losses. Yes, you do this with the trading system. The trading system will let you cut the losses. You ride the winners. Yes, the trading system will let you do that. You keep your bet small. That's how you when you trade multiple strategies, you just divide it up over those strategies, so you can keep your bet small, position sizing small for each strategy. Follow the rules without question until you know when to break the rules. And so, I'm not talking about breaking a rule intra-trade. It's not talking about during the day, doubling down or overriding a trading signal during the day. It's talking about when you realize a trading system needs to be changed or adjusted or removed, or you have another one that could be added or replaced. So, you can oftentimes this can be seen in the actual loss, but the more experienced you become, you look for the changes in the market that will point towards losses and anticipate. You don't always know when one strategy is going to go poorly, but you can see one strategy that's taking advantage of the current market conditions. So when you add that strategy, it can help make up for losses in strategies that are underperforming. And then when you can see those other strategies that are underperforming, they can be removed. And so knowing when to break the rules is not going in intraday and overriding trading signals intraday necessarily. Now, if we get a scenario where the S&P, the 5-minute bars, trades in 30-point ranges, up and down in 30-point ranges, when that's more than the average daily range, and you get that in 5 minutes, you might get a screaming email from me: stop trading, stop trading. I don't anticipate that would happen for all of a sudden the 5-minute bars trade in 30-point ranges, unless we had a major global event, meltdown, crash, but it would be more of a straight down move potentially than just a whipping around at the current levels in 5-minute bars where they're 30 minutes at the current levels. That typically be a big trend one way or the other. So it could be beneficial for short-term trading, but if some big global event like that happens, you want to analyze where you are when volatility changes, as an example of knowing when to break the rules. So if you don't have a strategy or system, how do you make good trading systems? How can you be consistent? It's just a gamble, in my opinion, if you don't have a trading method or strategy or experience. So 100% discretion, that's out really. 100% systematic, it's okay to start there, but what you want is systematic. You want your trading systems intraday, you're 100% systematic. Overall, your systematic discretion on when you pick your strategies, when you change them, and when to switch them out. So the difference is that, okay, 100% systematic during the day. I'm not making changes during the day. Unless some massive global event happens, if you get some limit moves down, and it could be like I say, a lot of my strategies do well with trends, and so a big move could be beneficial, but after a big global event, you want to reanalyze the scenario. I don't expect any global events though, so I'm just saying that as an example. So, so you need a trading system for these two, and that's what we have today. That's what we're talking about. So 100% systematic and systematic discretion in our portfolio. So if you lease a system, you can lease individual systems and run those, but with the portfolios, you get this extra benefit of systematic discretion. So you want something repeatable, scalable, as in any business model in your trading, and systems allow you to do that. So we're going to go over next, we're going to go over the market environment. So what was the 2019 market environment like? If you could define 2019, what would you say about it? It is a news-driven, trade wars, interest rates. There was low volatility, very, very low volatility. Recently, we've seen low volatility, narrow daily ranges. VIX is at 12 right now. It's been at 11 earlier this week. And we've seen some high volatility, not as high as 2018. We have bull market mainly. 2019 has been a complete mean reversion of 2020. So that 20% sell-off last December and the entire 2019 has been a complete mean reversion of last December. And so we've had mainly a bull market for the most part. Mainly because of Fed stimulus. QE4 is being talked about now. The overnight repo market funding problems has created a QE4 scenario. They're not calling it QE4. Also the Fed pivot, they were going to tighten in 2019 and then they eased instead, and so the Fed pivot was huge in 2019 and really big on this bull market. So pretty much a Fed stimulated bull market, and that's interest rates. We had a little bit of volatility when there was a concern of yield curve inversion and leading to a recession, but that has since the long bond has sold off and long rates have gone up. So the recession fears based on a yield curve inversion have diminished recently, the last couple of months. What do we anticipate in the 2020 market environment? News-driven, trade war, and we have an election. Election year should be interesting. All the things related to the election, all the conflicts creates uncertainty. And the more uncertainty that Wall Street perceives, that traders perceive, then the more volatility that we will experience in the markets. Low volatility, I anticipate this continued low volatility as long as there's Fed's accommodative and we're in this seasonal bull market period. So I anticipate low volatility, but I also anticipate high volatility. We don't turn a blind eye. We ride the trend as traders. We ride the trend of what is with anticipation of what could be. And so this is what is, and this is what could be, and this is not pessimistic. Not being pessimistic to think that there could be high volatility or bear markets. We just have to consider what we would do in advance in any situation as traders. So bull or bear market, so mainly a bull market, and still it's not pessimistic to anticipate a bear market. We're just preparing for what could happen as traders. So we have strategies that go short as well as long, and we don't want to turn a blind eye and just not be prepared. So when you passively invest, you just yield to one regime, and you kind of give up thinking about what you could do if something different happened. And that's why I and those of you on the webinar are the same way. You want to be in a situation, your personality is the type that you want to be in a situation where you're more proactive. In those situations, Fed stimulus seems like it's going to remain. It's been there for 10 years. And any thoughts of Fed tightening or Fed not stimulating created some volatility, and they came right back with an accommodative Fed, and whatever form they come out, they could change the form in which they stimulate or accommodative, but they continue to be there and be accommodative. And so that could change, though, and we anticipate that. Interest rates could anticipate higher rates or lower rates, or you have to consider all these things when you trade and how they could affect the market. And then you watch it in real time, and you oftentimes have aha moments, and you make adjustments, and then you test your trading system based on that. Here's some trading system guidelines I want to go over. You want to avoid over optimization, curve fitting, developing a strategy that works only on past data, because it's just really a mathematical formula. It's not really based on why it should work. And so if you can't explain your strategy, if it's not simple, it has too many parameters, it could be over optimized. We use general rules and parameters, use very simple strategies. And so we develop strategies based on market observations and not data mining. And so you'll see the ES after hours at the end of this webinar in the question and answer session. It's only 3 lines of code I'm going to show you. It's just based on a market observation. You see this market doing this every day, and then you say, okay, I see this pattern. How long has this been going on? You test it and you see, and you anticipate that the Fed is accommodative. It's favorable to this bullish trend. So we'll just keep potentially keep trading this until it doesn't work, since it has such a tight tight low drawdown. You can use that as a stop loss. And so one of the ways I develop strategies, I spend my day watching the market. I scalp or sim trade and to get a feel for the market. So the cost of development is pretty big on a resource basis as far as spending time with the market and just trading in general. In the beginning, sometimes you trade a lot of ideas that you're not sure of to develop a strategy. And so I've taken a lot of discretionary trades just to test stuff, to really get a feel for the market and have a relationship with the market. I don't think you can necessarily mine static data and completely get a feel for the market. So it's experience and hard work do pay off in trading. If you're looking to develop a strategy, it can take many years. I've told you guys many times it's taken me 5 years. It took me 5 years to come up with that first intraday strategy that I really sought to go full time in 2001. So strategy development catch-22s in 22 years of trading system development experience. This is what is true. So average trade profit and drawdown are the first numbers I look at. $50 is what I seek on a day trade basis before slippage and commission. We can go as low as 40s, and this is really for the time period for which the strategy works. You'll see some strategies that have negative equity curves for a while and then have positive equity curves and are around break even long term, but we still have them in the portfolio because they've worked from maybe this point, and in prior years they didn't work, but they didn't create a worst case drawdown for the whole portfolio while they didn't work. So if in the future they don't work again, some of the strategies that worked in this time period are traded, and so they will overcome the loss of this. And so in general, average trade profit for the portfolio as a whole, and you want that to be a part of your strategy during a significant period of time for which it should work. And you can, in theory, add a strategy to your portfolio that has a negative equity curve. You could potentially add a strategy that has this equity curve. If it works really well, at times your other strategies work very poorly, and it could improve your net profit over drawdown. theoretically speaking. So some of the ways to increase the average trade profit are larger stop loss, larger profit target, longer holding times. I say this because many people want to develop strategies that are tightly parameterized, that try to constrict and control the market, a control mindset. You feel like if you can use these tight stop losses and profit targets and just hit a bunch, you're hitting a bunch of singles and you're not being greedy, but your average trade profit diminishes and it's hard to ever be profitable. So once you have all these, what is also true, these all lead to more volatile equity curves. So if you try to decrease the volatility in your equity curve by tightly parameterizing these, your average trade profit goes down and it's hard to be profitable. So you have to hold, most of our strategies are longer term day trade strategies. They have higher stop losses. The smallest stop loss we have is about $300 per contract, and some have 800, some have 2,000. So that's on the minis. And so if you're trading the micros, it's 1/10 of that. So it's an important principle to understand. This may not seem significant to you if you've never developed a trading system. It may be like, why are you telling me this? This seems a little random if you don't understand trading system development. But this more volatile equity curve, this goes back to what we're talking about at the beginning. You can't avoid volatility in your equity curve. You have to have it by having stop losses and profit targets that are reasonable for the market. Sometimes they get questions. Do you have a strategy that has stop losses for retail traders? Well, the market doesn't treat retail traders any differently than it does professional traders. You have to have stop losses and profit targets that match what the market is, the way the market moves. You can't just, it's not going to treat you differently. You could trade smaller at this point with micros, but you can't just have tighter stop losses because you're a retail trader. So unless you find an extreme inefficiency, in which case that extreme inefficiency won't last long. I see a lot of traders seeking 3.0 profit factors. You can probably find a strategy that has 40 trades, has long holding periods, doesn't trade much, that has a 3.0 profit factor, but going forward, I don't think it will hold up very much because it's just too much of an inefficiency. If you trade frequently, you're not going to find something that trades a lot and has a 3.0 profit factor. That would be a glaring inefficiency in the market that would get quickly mean reverted. So let's look at strategies from 2019. These are some of the strategies that performance report for 2019. So we released the current stock index portfolio at the end of June, and it's based on systems that we've had, as well as some new strategies. So some of these strategies we've had since 2001, 2004, 2005 time frame, or some of the original development dates on some of these. And so, and then some are new. So it's based on the 2019 market environment. We will look at the results of these strategies. These reports go back to 2001 for NQ and 1997 for ES, and they include slippage and commission of $25 round term per contract. I'm going to show you screenshots of, you can also download these at the end of the webinar. I'm going to give you a link for that. And so these include 25. I'm actually going to show you two charts for each, one without slippage and commission and one with slippage and commission, so you can get the real slippage and commission effect. Spent most of Monday and Tuesday putting these together. It takes a long time to generate these reports. I can't have all of my strategies in my workspaces going back to 1997 and 2001, or it will crash the computer. It takes up too much memory. So you have to move each one back to 1997, wait for it to load, and then move it back to the current date. And so that is valuable information though. All strategy results are based on trading one contract. It's not a multi-contract compounding environment. So, all right, here is AT 2019 E-mini S&P. Left side, you see no slippage and commission over here. And then over here, you see it with slippage and commission. We've actually updated this strategy for 2019. And you see AT 2020. And this does much better on the short side. You see the average trade profit for a day trade strategy, 103.51, going back to 1997. It's really good. And this mainly does well on the short side. So we have a short only version as well. And since it does mainly well on the short side and we've been in a bull market, you see it hasn't done much here, didn't do much here, didn't do much there. And so there's time periods where it doesn't do much. And then you add slippage in commission and you see these down times. And so looking for a cycle, we're due for a cycle. And so that's AT 2020. Here it is, the short only on the left, a little bit higher average trade profit, 114.89 after slippage and commission, 67.6250 drawdown. And so you see this time period here. You see a lot of trend strategies from 2009 to 2014 didn't do as well at 0% interest rates. Price discovery is more difficult, and mean reversion and counter trend did better during that low volatility 0% interest rate time period. Cover 3 E-mini Nasdaq with slippage and commission. Here's that 2009 to 2014 time period that we're talking about. Actually, 2015 is when interest rates started going back up. And so also the level of the NQ, the price level of the NQ makes it more favorable during this time period. The higher a market is, the greater the average daily dollar range if it moves on a percentage basis. So that's Cobra 3 E-mini Nasdaq. This is one developed in 2004, 2005, originally for the E-mini S&P, and the AT 2019 was originally developed in 2001. SR Counter Trend 2 E-mini S&P. This is a progression of development since 2012, and you see nice results here. One of the things I'm going to show you though is I like to put portfolios together with strategies that are at equity peaks, such as SR Counter Trend 2 E-mini S&P, and strategies that are in drawdowns. The last thing I want is 10 trend strategies all at equity peaks on one market. So you see the average trade profit meets our criteria there for that entire time period to 1997. And so I challenge you to find a strategy that trades that much. You have a lot of trades. Trades that much, test well back to 1997, over 22 years. E-mini Nasdaq, it's currently in its drawdown phase. So you see the drawdown on the Nasdaq. One of the things we see here in the current market is that the ES is more counter trend. So we've biased some of our smaller portfolios to trade ES as counter trend and NQ as trend and counter trend. So NQ trends better, ES counter trends better. So Gap Fill Master, E-mini S&P, taking a look at that. This is in the book members area. It's not in the book. It's an update of Gap Fill 1 from the book, developed in 2010. So Gap Fill 1, developed in 2010, has a positive equity performance as well to date. And so you can get that book and see the multi-year out of sample performance since 2010. The code is in the book on Amazon or on my website. And this is an updated, more selective version. We made it a little bit more selective to boost this average trade profit, and really nice equity curve. Some of you like these 77% strategies. I like, one of the other things I do in my portfolios is I like to have strategies that are, this has a $200 profit target and a $500 stop loss. And you can always see that on a day trade strategy by looking at the largest winning trade, 200. The largest losing trade is 500. And so when you add the slippage and commission, 175, and the largest losing trade is minus 525. You can see that there. So if you know the stop loss is 500, you know that if it includes slippage and commission, if you look at the largest losing trade and the largest winning trade. And so when you have a profit target that's closer than the stop loss, you can get these high percentage winners. And then I also have strategies that have tight stop losses, like $300 stop losses, exit at the end of the day, or have larger profit targets. And so a diversity of exit strategies is what we'll talk about when we develop portfolios. I've already revealed some things like starting with strategies that are at equity peaks, some in a drawdown, a mixture of those types of strategies, and then different exit methodologies. So these are different exit methodologies that are used in this portfolio of trading systems. So adaptive moving average, love this concept because never did well with moving averages, but I found a way to change the L1 and the L2 adaptively based on percentage moves, and so it's pretty interesting how this works. And so it's back test to 1997. It's a volatile equity curve. You see that, and even more volatile with slippage and commission. But we like this strategy, and it works well in our portfolio. And it's recently developed the last 2 or 3 years. And tick count trend 2, version 2, developed I think 2011. And let's see. Low average trade profit, so it trades a lot. It has a let's see, it trades frequently, so it has a fairly low average trade profit, but it does well in our portfolio. It really improves because it is such a counter trend strategy that works on the E-mini S&P, and you see how much it does. It's done much better in recent years. See, if you look at the average trade profit of 35, and you look at how the stress it endures under slippage and commission, you realize that recent years average trade profit is higher than 35, and so that's why one of the reasons why we still keep this with the average trade profit low, because this time period back weighs on this, weighs on the average trade profit. And so in recent years, the average trade profit is better, and the system's in a drawdown similar to this, and so we like to get strategies that are also in a drawdown. Let's take a look at tick count trend 2, V2, 5 minutes, same strategy on 5-minute charts. And so, you know, it has a long period underwater, and it starts to perform well here. Nice equity curve there, drawdown, nice equity curve here, a little bit of a drawdown. And so, you know, average trade profit 31.64. Obviously, this time period weighs on that drawdown, and so from this period forward, the average trade profit is much higher. Mirror E-mini S&P, it's a mean reversion strategy. Like this strategy, keeping an eye on it though. This is one we may make adjustments to, and you can't trade strategies with this big of a drawdown unless they're in a portfolio, because it falls into that category where you know, a losing strategy helps a portfolio because it is so different. And so average trade profit's a little low. We're watching this strategy. We may modify it, may take it out, may change it. So this is one on the list that we still have, but we're watching. Night Trader E-mini S&P, one of our favorite strategies, outstanding performance the last 3 years. Anticipates this will continue, but it can go through these drawdowns, and it's hard to. I mean, look at how well it does. It either does really well or really poorly, really well or really poorly. And it's hard to trade this without a money management algorithm or in a portfolio configuration. You don't really want to trade a strategy with a $32,000 drawdown unless you're trading it in the context of a portfolio, have other strategies to do well when it performs poorly. So, all right, QS3, here's one that we're keeping an eye on as well. It's you know, poor time period here and does well here. Average trade profit 63 though, even throughout this time period. So with slippage and commission, it's 38. But our criteria is without slippage and commission. We really like to be on over 50, or if it's not over 50, we have to have a rationale that the last several years it has been and it's favorable for future market conditions. But it's pulled back here, and it's on our list to watch. Looking for a recovery here in this strategy, and I do like to get strategies that are in a drawdown. You can do that in a portfolio instead of just trading them on their own. So tick pulse. Really outstanding equity curve, really, from this point forward. You see it's pretty smooth overall without slippage and commission. And then when you add slippage and commission, this time period is more break even. And then this time period, it's done well. And it's recently had a pullback, which is not as trendy. It's a strategy that works on trend markets. And so we're not really trending that much lately with this low volatility intraday. Even though we're in a bull market, you get a lot of gap up overnight, sideways during the day, gap up overnight, sideways during the day. So night trader will capture these overnight. The 60-minute breakout will capture the overnight. And so night trader, we already looked at that. So I think I have some duplicates in here. Gap continuation 2019. Here is an example where slippage and commission really has a big factor. You see add slippage and commission, and this whole equity curve goes underwater during this time period. But because of the levels of the Nasdaq and because of how well it's doing in this time period, we keep this and we can put it in the context of a portfolio. Even though it has a $42,000 drawdown, the portfolio doesn't even have a $42,000 drawdown because the other strategies do well when this is doing poorly. And so different strategies work well at different time periods. And so we will keep an eye, on all of our strategies really. And so we're constantly watching to see the strategy's performance in the market conditions and watching the market conditions as well. Stock index swing, E-mini Nasdaq, this is one that's pulled back, keeping an eye on it. And so this tends to do well on more trendy periods. It hasn't been as trendy lately. There's some days where the markets are trendy, but for example, our Cobra 3 E-mini Nasdaq strategy, one of our favorite strategies, has had this pullback as well, because you get that overnight trend and then the intraday chop, overnight trend, intraday chop. And so like I said, when we develop, here it is again, I have this duplicate slide. So like I said, we'd like to add strategies that are in run-ups and strategies that are in drawdowns, because they're at different cycles in their performance. So tick pullback, E-mini S&P, nice equity curve without slippage and commission, incredible amount of volatility when you add slippage and commission. But during this time frame, this could be a strategy that could capture a runaway market, has a tight stop loss, and that's why we have it in the portfolio right now. Tick pullback, E-mini Nasdaq, same thing, because of the type of market we're in. Sometimes it's hard to capture runaway markets, and this has the potential to capture a runaway parabolic market. Again, tight stop loss on this, and so we like this strategy. And as always, we keep an eye on all these strategies for the market environment. May have some potential adjustments for that one that I'm thinking about. Tick count trend, E-mini Nasdaq, another one, exceptional performance during this time period. As the levels in the E-mini Nasdaq rise to higher levels and the daily dollar range goes up, this strategy continues to perform well. And we want to be able to trade a runaway market if that exists. And this is a negative strategy to 2001, but very positive from trade 2000. So the last 800 or so trades has done very well. So this is a $48,000 drawdown, and these drawdown curves are included in the portfolio report, at least back to, we're looking at back to 2008. So I'm not sure what time this is right here. I think that's, I think 2008 might be right there. But that's the tick count trend, E-mini Nasdaq. SR counter trend 2, V2 E-mini 1, E-mini S&P. So I have a lot of these right now. I have a lot of SR counter trend 2, V2. There is the 1 minute, there is the 5 minute, there is the 15 minute, and they are all pretty correlated. And so it's for the ES, and then I have all of these as well for the NQ. 1 minute, 5 minute, and 15 minute. And those are all for the NQ. And they're counter trend dip buying strategies. And you see that it's at equity peaks over here, a little bit sideways over here with slippage and commission. These also have an M version, which also then re-includes all 6 again. So 12 strategies overall between the 1 minute, 5 minute, 15 minute, ES and NQ, V2 and V2M. And so we're going to go through those reports very quickly. E-mini Nasdaq, nice move here at equity peaks on this with slippage and commission. V2 1 minute, there it is. Let's see at the next button. There's the V2 5 minute E-mini S&P. It's at equity peaks. It's had a better run recently than its 1 minute version. Here is the 5-minute Nasdaq. It's pulled back. The 1-minute version is up, but the 5-minute is pulled back. So you have some diversity, even though they're correlated in the way they work, because they're on different time frames. You have a little bit of diversity here to work with. So this is a really lower frequency. The frequency goes down the more you go up in the intervals. There's less trades in the higher intervals, and so pretty nice equity curve without slippage and commission. It gets a bit more choppy with, and we're not afraid of choppy equity curves because it's a strategy that performs well when others are not. We like those choppy equity curves. Those are realistic equity curves. So here it is. This is a 15-minute version, recent drawdown. Let's look at the V2M. Now we're looking at the we just looked at 6 combinations of the V2M for the 1M, 5M, 15M on the ES. And then we're going to do the same thing, 1M, 5M, 15 on the ES and the NQ. The NQ is going to have all these time frames, and we're doing the V2M now. We did the V2, now we're doing the V2M. It's a modified. So it's a lower frequency version. V2M is a lower frequency version. So nice run here, even with slippage and commission on the E-mini Nasdaq, on the E-mini S&P 5-minute. It's pretty choppy on the 5-minute Nasdaq. You see that there, but nice recent performance. And here's the 15-minute E-mini S&P, just a much different looking equity curve. So I like it because the equity curve just really looks a lot different than the other equity curves. And the 15-minute E-mini Nasdaq. So just different looking equity curves, different frequency. So we have ugly equity curves. This is an example from the 200K portfolio. You have all these ugly equity curves. We don't chase perfect systems because in reality, they just don't exist. And I find more power in looking at strategies that are not perfect, but are developed well to catch certain type of market regimes and then combine them all into one. And so real strategies have ugly equity curves. This isn't an excuse to be lazy. It's not an excuse to be lazy. Some could maybe perceive this as saying, "Oh, that's just lazy. You're just not trying hard enough. Just try harder." I have so many people that come to me and they still don't understand this concept, and they still just burn out trying to create perfect strategies. So it's definitely not an excuse to be lazy. You definitely don't give up on developing. You're constantly developing, but you're also balancing your developing with reality. And so reality is a key word there. Don't go crazy adding a bunch of rules and optimizing and curve fitting. So real strategies have ugly equity curves and can go 1 to 2 year periods between equity peaks. This is, it could go even longer in some cases. We saw 5-6 year periods where some of the trend strategies after slippage and commissions go sideways. Your system will eventually have a 5K plus drawdown. So anticipate worst case drawdowns. If you have a system with 2K drawdown, don't hope it never has more than that. Anticipate a higher drawdown. Try to develop other strategies that work when it doesn't, and test it over a longer period of time, not just the last year. It's kind of turning a blind eye and having some bias to just looking at the last year or two and saying the market is now going to trade only as if it did the last year or two, and I will know for sure when it doesn't. So to avoid whipsaw losses, stop trading, and other HYPOTHETICAL market wizards really putting in this concept that equity curves are volatility, that trading is volatility. Top commodity trading advisors, professionals have 5-year drawdowns. So we've talked about that before. The next best thing is a diversity of strategies. And so, when you combine these equity curves, you do get a nice equity curve, but this nice equity curve still has drawdowns too, and it still has to be managed going forward. We do expect some degradation in strategies and potentially the portfolios. We have to be aware of that. So portfolios for 2020. With our long list of strategies that I put together for 22 years, I want to show you how I develop a portfolio. So I see a lot of traders trying to develop strategies to eliminate the pain. We've talked about this. This industry attracts very analytical people, so you have these tools and you can give you a false sense of confidence with all these tools. So what is the solution? You're stuck trying, if you don't have a portfolio strategy, you're stuck trying to predict the future. Which strategy should you trade when? I don't believe that you could predict the future that accurately because there's lots of predictions. Some people might predict some major market move once or twice, but to always try to predict which strategy is going to work on a short-term basis, you're setting yourself up for failure if you try to predict things. Trading is not predicting. Poor strategy development, over-optimized, curve fit, unintended biases, and you make compromises. So good strategy development is important, and a good strategy does have drawdown. Different set of strategies for different market conditions. This is the best solution in this portfolio of strategies. Each strategy acts like a module for different market conditions, like I said. And so strategies for the current market condition should do well for its defined market regime, and so we make sure that it does that. And then this one, it's kind of a pessimistic view. Don't do terrible during periods when it is out of sync with the current market. So most people aren't going to think like this. This comes across as lazy to say don't do terrible. We live in an A+ world from academia. You want to do perfect. You want to be perfect. And so you have to be realistic though and realize that in trading that you're going to go through drawdowns and still try to avoid as much drawdown as possible, but realistically, not perfectly. Realistically versus perfect is different. So here's how I develop algorithmic trading system portfolio. And this is what I do after I have my list of strategies. So I combine a list of strategies to provide diversity, and then I include different entry methodologies. We've talked about this. I've been talking about this along the way while we looked at the performance reports. Trend, counter trend, and mean reversion. Mean reversion is kind of a subset of counter trend in a way. Use different exit methodologies, like I talked about, different size stop losses, some with large stop losses, some with small stop losses, some with tight profit targets, some with distant profit targets, some swing trade, some day trade. Most of the strategies in the portfolio are day trade. We include strategies in a drawdown and strategies in a run-up. We talked about that. Strategies that have a long history and strategies that look at more recent data. I used to have more emerging strategies. I don't want to do that as much anymore. I want to require there to be more data than 18 months. So I tried to jump on some pretty hot strategies that have 12 to 18 months of data, and I don't like to do that as much. Every now and then I might make that opportunity as an optional to you, and you can decide. But for the portfolios, I like to have some equity curves with some longer periods that are available than 18 months. So these portfolios represent the systematic discretion that we seek, as you will receive the updates throughout the year. When you get these portfolios, they're not just strategies. We have updates for them as we see the markets change. This isn't a fixed set of strategies we will trade for the next 12 months. If there is new observations, then we will make adjustments and send them to you. Now, I mean, if these strategies in the market lines up and it just does really well for the next 12 months, it's possible that we would not need to make changes. Maybe we're spot on for 12 months, but long term, there will be adjustments. There will need to be changes, and so anticipate every 3 to 6 months making some adjustments at least. We're not talking about every week or every month. We're talking about every 3 to 6 months potentially making some adjustments depending on where we are to either to the individual strategies or to the portfolio. Maybe we modify a strategy, maybe we add a strategy, maybe we remove a strategy. So having known all this, here's what I put together for 2020 that takes advantage of what works now and what has worked in the past. So if you have the portfolios, you will get these updates. I've added 4 additional strategy combinations, and so we're going to go over. This is a new introduction. We have a 30 system portfolio that we've been showing you for 2019, and we now have 38 strategies in a light version, I guess you could say, and a 38 strategy version. It trades 2 different markets. We're focused more on diversity through methodology versus diversity through markets. Now, before the new year, we're going to have another webinar that talks about our all access, all strategy access, and includes other markets such as gold, crude oil, silver, RBOB, soybeans, so some other markets that actually improves the portfolio as well, the return over drawdown, and it would include the stock index portfolio. So if you get the stock index portfolio today, we'll have another webinar and you will be able to upgrade to that. I want you to get started before the new year if you want to start trading on January the 2nd. If your goal is to start trading something on January the 2nd, you're going to be proactive, it's important that you go ahead and get started now, so you can get everything set up and make sure that we have it all set up and working for the new year. We're into the last 2 weeks of the year, so it takes a little bit of time to get everything set up. So we trade, these strategies trade different methodologies. It's a culmination of experience of what works now and what has worked in the past. So here's what you get, 38 individual strategies. We have a 19 strategy, 23 contract combination. So 4 of the strategies trade 2 contracts, while the other 15 strategies trade 1 contract. So you're trading 23 contracts, and you trade 38. You can trade the 38 system contract version as well, and you can customize your own combination. You get all updates, upgrades to the portfolio and strategies, and so you get the technical support for your strategies as well. So now I'm going to show you this in the portfolio calculator. You can download the portfolio calculator from the portfolio calculator page, and this is through this past weekend. And you see these are the 4 strategies: Cobra 3 NQ that trades 2 contracts, Tick Count Trend 2 V2 1M and 5M trade 1 contract or 2 contracts, and Tick Pulse V12 trades 2 contracts. So the drawdown is lower than our 30 strategy portfolio. It's trading 19 strategies. This is number of systems. This is really set up to count the number of contracts. So the number of systems is really 19 on this setup, because it's just summing up this column. And the total profit over drawdown is 35.70. Now we have a 38 system portfolio that includes all stock index strategies that you see in the portfolio calculator. This number is lower, but the total net profit is higher, and the drawdowns recover more quickly. So while the drawdown is deeper, some of these drawdowns last a little longer when you have less strategies. So you'll see, I'll give you a preview of the 200K portfolio during the question and answer session, and how narrow these drawdown curves become when you add other markets. And so it does take more capital. So the less capital you have, the less diversity you can have. So this is the 23 contract, 19 system portfolio. Now we're going to look at the 38 system version with 1 contract on each. This is just all the stock index strategies that I have. Copy and just paste this down. In previous years, this used to be an integer. Now it's a decimal, so you can test it with micros. You can put 0.1 in here, and that would represent a micro. So when you get the portfolio, you can get it with the micros or the minis. And so the micros, you would anticipate 1/10 of the results, because it's 1/10 of the size. But because of the slippage, because of the commission on the micros, the commission on 1 micro is greater than 1/10 of the commission on an E-mini. So you're going to anticipate 1/10 of these results from micro, and then maybe 60% of the results based on the increased cost of the commission involved. And so let's take a look here. You have some 6-figure years. And so looking at the years, we didn't look at the drawdown curve as much. We did look at it though. But you see how quickly the drawdown curve recovers. These gray areas are narrower. And with the 200K all strategy access portfolio, you're going to see very narrow equity curves. And so you see a larger drawdown than the 38 strategy portfolio. It had 30K, now you have 46K. This is twice as much as 19 systems. You have twice as many systems, twice the drawdown. Your diversity is greater. I think your future diversity is greater, and your drawdowns are recovering more quickly in recent years. And so That's the rationale. We really like to improve this number, but absolute total profit over drawdown is not always the most important thing. The concept of sense of future diversity and where the markets are heading. You see the annual profits over recent years trading all 38 of these strategies. And you have to be prepared for this, nearly 50K drawdown on the minis or 5K drawdown on the micros. And so that's the combination of 38 strategies. And so if you want to download the portfolio calculator and change it back, the numbers are over here as a guide as to what strategies are in the 19 strategy portfolio. You could put this number here, and then if you want to look at the 38 strategy portfolio, you just put a 1 in all stock index strategies. So all stock index strategies go to there, and then after that, it's just you have euro, gold, silver, crude oil, soybeans. Not all systems, not all markets are day tradable, and most of our strategies are day tradable. So, you don't want to day trade corn with the strategy. It's kind of hard to do. It's possible, but kind of difficult. So that's the portfolio calculator and how you can calculate. You can customize this too. You'll get all 38 strategies. You could go in here and you could do any combination of strategies that you wanted. Number of contracts could change, and so you may come up with a setup that I have not with these 38 strategies. So most of these are day trade. Let me go in here and say the 60-minute breakout is overnight. Stock index swing, it says DT incubate, it's overnight. Let's see, Asia 4 long is overnight. 60-minute breakout NQ is overnight. Night trader is overnight. And so the rest of those are day trade though. So 90% day trade roughly. And so back to the PowerPoint presentation, you get all 38 of these strategies. You can customize them if you want in the portfolio, and then you can automate the strategies that you want. So this is available in the following platforms right now. It's just in TradeStation and multi-charts, and this is not the .NET version. I don't include the .NET version, but NinjaTrader 8, I have not fully developed them all the strategies yet. It takes me longer to program things in NinjaTrader 8, but I will have those. And if you have NinjaTrader 8, let me know, and let me know when you're interested, and I'll let you know a time frame on when they'll be available. I have quite a few strategies available in NinjaTrader, so we could customize it if you're ready to get started by the new year in NinjaTrader 8. And so let me see, how do I get rid of that? So it won't let me get rid of that for some reason. But so let's see. So historically, the basic cost of a strategy is $50 per month per strategy. So you're looking at 38 strategies, $450 per year when you do an annual subscription. If you just do monthly, it's usually $50. So you get a discount when you typically do an annual subscription. It is $600 if you pay out month to month, $450 per strategy per year if you just pay up front for a year, and some of the special offers are $24.50 per year. We recently did a 25K portfolio rate at $19.95 for 10 strategies for the year. And if you buy open code, it's a lot more expensive. It's my life's work, 10K plus per strategy. So those are historically the basic cost of strategies. So what I have for you today, a special offer on the stock index portfolio for the minis and the micros, slightly different offer for each. You get all 38 strategies for $39.50 instead of what you see on the web page for the stock index portfolio of $49.50. You get a subscription through January the 1st, 2021. So you get the rest of this month essentially free. And so the sooner you subscribe, the more advantage you can take of the free month and get set up to get running by January the 2nd. So if you want to get running in the new year, if you're ready to start trading on January 2, 2020, for the full year, now is the best time to get started. The holidays are coming, and it takes a little longer to get set up if you come in on New Year's Eve probably won't be able to get you the strategies until, you know, the 4th or the 5th. So it just takes a little bit longer. You get all upgrades for strategies and portfolios during your subscription. So this is part of the systematic discretion that maybe you would normally have access to if you just lease a strategy. So you get the complete instructions and support to get you set up, work with you until you get it set up. And the deadline for this is December the 23rd at midnight. If you sign up on December the 23rd at midnight, probably won't be able to get the strategies to you till the 27th. So if you do that in the next day or two, you can get you those before Monday. If you do that the next day or two, and get you to get those strategies to you this weekend or before Monday, so you can have them for the rest of this year and all of 2001. So that's the benefit of going ahead today and getting those strategies. So we should be sure to have those strategies. This is for the minis. The micros have a lower price because they are 1/10 of the size. So the micros, the basic price is $9.95. I can't lower that, but I can give you 2 extra months on the micros. So that's the opportunity in the micros. You get 2 additional months when you get the micros. So if you're new to trading, want to trade small, want to trade the micros, even though the profit ratio is lower because the commissions are higher on the micros per contract. So 1 ES, the commission on 1 ES is less than 1/10 of a micro. MES is a symbol. MES is a symbol for a micro. So that is something to consider too, because your commissions are going to be higher. If you were to trade 10 micros, your commissions would be higher than 1 ES, even though it's the same market value that you're trading. So I have the link for this. I'll put it in the chat area, and we're about to get to the question and answer session. So let me get the link for you for this. And that is I'm going to put it in the chat box here. And there it is. I'm going to pull that into the screen. So here is where you land on when you click on that link. You can also find it on my website by going to Capstone Trading Systems, go to Market Portfolios, and go to Learn More about the Stock Index Portfolio. Get the special webinar offer. The wealth of information when you download the individual reports is there. You get the MHTs and the JPEGs. So you can quickly scroll through the screenshots on the JPEGs with and without slippage and commission. Then you get the MHTs with and without slippage and commission. And that's for the old portfolio. I'm adding, like I said, I'm adding 8 additional strategies to this. So you have 8 additional combinations versus what was available in 2019. And you know, because you're trading the 19 system portfolio could be traded with 75K, maybe aggressively with 50K. Ask me about that. 140K for the 38 system portfolio, potentially aggressively with 100 and 125K. This assumes that all strategies take a net position and you start at an equity peak. So one of the things about it is that I've never seen all strategies take a net position. So let me show you that real quick in the portfolio calculator. So for example, the margin requirement is $90,000. So if you said, you know, I don't think that more than 2/3 of the strategies will take a net position, or I never see more than half usually. So that means that they're all long or all short. They usually take opposing positions, even if 2/3 of them are trading, there's opposing position. So your margin could be, you know, 45K, and your if you're in a drawdown like this, for example, you almost get this portfolio, you could consider wrapping the drawdown into the portfolio, saying that I'm in a $7,000 drawdown that I missed, and the portfolio is only $39.50. So it's like starting at an equity peak. You're almost getting it free because you're missing that $7,000 in trading loss if you start right there in that drawdown. Now, this drawdown level is as of this weekend. I'll have to get you the latest. There haven't been that many trades this week because holiday trading hasn't done that much. So I could get you the latest drawdown numbers as well, and you could almost just say, yeah, I missed the trading loss, and so covering the missed trading loss with the portfolio. But you also, if you say, half the strategies take a net position any one time, and 46 minus 7 is 39K, so I need 39K to a worst case drawdown. You could add those two numbers up and come with the number 85K, and that's be very aggressive to trade this portfolio with 85K, but that would be a more aggressive approach. I recommend being more conservative, being fully capitalized, and trading smaller. If you're thinking about trading, I have $1 million, I will trade 8 contracts. I would say, man, maybe back off to 2, 3, 4 contracts on this. The worst case drawdown is 46K. You have $1 million. Maybe you only want to risk less than 10%. So you trade 2 contracts with $1 million. So the more capital you have, the more you tend to deleverage. So you can scale as well as your amount increases. You could scale. So if you have more than $1 million, you could trade more contracts. So the portfolio was 10K, 100K, $1 million plus. You could scale beyond $1 million easily in this because in most cases when you have $1 million, you're not trading as big. You're not using as much leverage. So if you had 2 million, you could trade 4 or 5 contracts, and so you could actually do that with 200K. You could trade 4 or 5 contracts with 200K, or even more, and that's very, very aggressive, and you'll probably experience a lot of emotions if you do that. You want to trade at the level where your emotions don't affect your decision making, and so that is one of the things I want to make sure you understand about volatility in your account. It's a recurring theme. So go to this page. You can close this if you want and read more about the stock index portfolio. This is based on 2019. We've talked about 30 strategies through 2019. After this, we'll be talking about the 19 and 38 system setup. And so there's 22 ES strategies, 16 NQ strategies. So you have access to a lot of strategies. And if you want to join the special offer, you can go with PayPal. You can click on either one of these offer you PayPal. And so micros, 10 to 15K account, 38 strategies, and you're enabled for up to 2 micro contracts per trading system. On the mini portfolio, 75 to 140K account, you get those same strategies and 4 mini contracts per trading system. If you have any questions on the reports, you can also ask me. You can get the latest drawdown as well. So where are we on the webinar? So do I have any questions so far? Here is a special offer once again. So I've shared quite a bit of information, and this may not be for you. Maybe you don't want to take these kinds of risks. You have to know yourself well enough to know that, and that is fine. It's not futures trading and algorithmic trading is not for everybody. But if you're like me and you seek, you're okay with some risk to seek new opportunities, then this can be for you. This offer right here, trading like this will take someone that has never traded a single strategy, never developed a single strategy, the ability to trade like a pro, because you're trading our strategies that we developed over the years. It's similar. I mean, if you could, my brother-in-law is finishing medical school, his residency, a lot of effort to become a doctor. You can't just transfer that through purchasing. You can't purchase the skills of a doctor. It'd be neat if you could just, hey, I want to be a brain surgeon. Here is $200,000. Transfer your brain surgeon skills to me, and then automatically you could just go be a brain surgeon. So very rarely do you have the opportunity to do something like this. Imagine being a lawyer, imagine being a rocket scientist. I guess it's Similar to franchises, oftentimes people sell franchises, they have a proven business model. While there's still risks involved about the future business model working, there is no guarantee. You have the opportunity to buy the trading system franchise model. And so that's what we're offering today. Question and answers. The link is in the chat. Do you have any questions? So let me see if I can get to the questions now. I can, I'll have to go back and look on the NT8. I know I have most of the ES strategies actually. There's quite a bit of them available. Let's see, how do I? So Warren, it's I can get you that if you'll email me. I've been so focused on developing this new portfolio. So what I do a lot of times is I develop portfolios, and I'm going to show you the code for that strategy in a minute. It's very easy for me to develop a strategy and make my modifications, and spend many hours, worked really hard to put all these performance reports together. And you know, I put a lot of time into it, and I develop it in TradeStation. And then once I have it all set up, I go back and code it in NinjaTrader. NinjaTrader, it just takes longer to code it. It's C#. It's not easy language. And so that's one of the reasons why I don't have it developed yet. And so when there's updates also, it takes me longer to get the updates out in NinjaTrader because they have to be coded in NinjaTrader. So I'm glad to, if you could, Warren, if you could send me an email. And it's a good question, Warren asks, what is available now in NinjaTrader 8? And so I will get my list together, my updated list, because I had all the ES strategies from the 30 system portfolio, 17 ES strategies, and that alone was a good portfolio. So you can email me about that, and I'll have that. So now that I've just gone through this period of time where I've really pushed for data and information and getting this portfolio set up before 2020, I then go back and set it up in other platforms such as NinjaTrader 8. And you know, I could possibly have it by the end of the year. I have to go back and see where I'm at and can't remember right off the top of my head. So I'll have to go back and look later today. So good question. What data feeds are required? You need the CME for the indexes. You don't, on the CME, we're not trading the meats or the currencies, we're just trading the indexes. CBOT for grains, we're not trading bonds. COMEX, actually, you know what? I'm telling you what you need for the diversified portfolio. Scratch these for the stock index portfolio. Scratch these. You only need the minis. Whatever you need with your data feed provider is the CME, and you just need the level 1 for the minis. If you have the market depth indicator, then you'll need level 2 for the stock index minis. I think there's a as a pro, there's a special price. We pay different fees as pros. The CME is 105, but if you're just doing the minis, it's 40. But if you're not a pro, it's I guess $5. There's different fees for where you are. So I think it's only, if you're not a pro, I think it's only $5 or $6. If I'm going to get the full CME for me as a pro, it's 105 and $40 just for the minis. So you just need the NQ and ES real time. You need the VIX, which is free. This is the cash VIX, not the VIX futures. And you need the NYSE because we use market internals. Important note on market internals, there's some strategies, and Warren, this applies to you and those that have NinjaTrader 8. The strategies that use the NYSE tick have slightly different performances because the NYSE tick, which tracks the number of upticks minus those into downticks instantaneously, is generated by the market provider from the list of 3,700 stocks on the exchange. It's not sent by the exchange, and so you get different values. TradeStation values tends to be more extreme than what I've seen in Kinetic. So if TradeStation values are at these levels, Kinetic values, they have narrower ranges. And so I don't know if they sample less or if they filter it or what, but the NYSE tick strategies are slightly different. There is no NYSE tick sent by the exchange, and I actually have a video on my YouTube channel if you want to know more about seeing the NYSE tick trading differently in real time, side by side in Connecticut and TradeStation. I can show you that video. I don't have it memorized off the top of my head. I'll have to look it up and send it to you. So email me if you want to see that. And so that does affect a few of the strategies. And so we have TradeStation, the platforms. We have multi-charts, but not multicharts.net. That's a .NET C# language, and I can't just take the NinjaTrader C# and put it in multicharts.net. So the .NET C# is similar, but it's still really different. And so it's a completely new language when you program in multicharts.net. But if you have the basic multicharts that uses Power Language, TradeStation, and NinjaTrader 8, many of the strategies, the majority of the strategies here today are in that. This screen looks really messy, I know. Let's go to the next screen. Just go ahead and type your questions in the box. I know you're probably waiting for the code, and let's just go ahead and go over that. So here is code. This is not the code in easy language. This might be more like what you would see in C#. This is more of a C#. I guess it may be a JavaScript type code, and so it's harder to read. Here is how simple easy language is, and this is how I like to keep my strategies simple. Now my strategies are not this simple. A couple of them are, but most of them are, a little bit more complex than this. And so the ES after hours strategies that you saw earlier has 3 lines of code. 1, 2, 3. Those are comments. We trade this on the E-mini S&P 60-minute chart on exchange time. And if time is 1600, that's the last time of the day session on exchange time, and the close is less than the close of 23 bars ago. Why did I use 23 bars? Is that an optimized number? No, there's 23 60-minute bars in a day. So I'm just finding the close of yesterday by using a look back period of 23. If we're down on the day, if it's the close and we're down on the day, we just go long at the close of the day when the market reopens. So when the market reopens an hour later, we have a limit order for the next hour at the current day's close if it closed down on the day. Then we exit at midnight or with a $700 stop loss. Simple. 2 of those lines are exits, and one of these, I guess you could say there's 2 rules if time is equal to 600, but we're just saying if time is equal to 600 just to get the closing price of the day. And then we place a limit order at that closing price if it was down on the day. And so you see how simple this setup is and how good that equity curve really is for the last 10 years, how inefficient the market is, how extreme bias to the upside we've seen in the market just based on that. So there's the code. Any other questions that you might have? If I missed your question somehow, I'm not an expert at using these webinar tools. Yesterday we had a flash webinar where it did not, the screen kept flashing. So that's why we're redoing it today. If you didn't, you probably know that, but if you didn't, that's why we're redoing this one today to get the recording and to make it available to you today because the recording had some technical errors yesterday, to say the least. So that's the code. Hopefully you have that by now. Email me if you do not. So like I said, we have upcoming webinar, 200K portfolio, all strategy access. I want to give you a sneak peek of that so I can show you what I'm talking about on the drawdown curves. So the all strategy access, you'll have access to lots of different portfolios that we're going to share with you through 2020. We're going to add additional strategies, and we're going to share additional portfolios with you. This is not it by any means, and we're going to share that with you coming up. And if you want to get this, the stock index portfolio today, and you come to the webinar for the all strategy access, you can upgrade for the difference in price when we have that special offer available. So don't hesitate to get started if you want to get started today on the stock index portfolio. I'm going back to show you what I've found here. I want to make this number 8,000. So that's what I'm going to do, and that's the benefit of trading additional markets. You can only diversify so much within one market sector. You get much better ability to diversify when you add additional markets if you have the capital. If not, you can scale there and get there. So now we've gone back to the 19 system portfolio. We need to add 2 there. So we're back to the 19 system, 23 contract model. It's actually a little higher with just one tick pulse V12. So you could also do that. You could customize. The drawdown was a little lower there. So 3587, a little bit higher when you do that. So tick pulse V12, we'll just go back to this. And then we're going to add all of these strategies, not including Cobra Euro. Cobra Euro is a little tricky because Cobra Euro 2 has outstanding results. In the last 3 or 4 years, it just hasn't generated many trades. So we came with Cobra Euro 4 to uncover those stealth moves. It seems as if the Euro currency market has become more stealth with its trends. And Cobra Euro 4 works well the last 3 or 4 years, but does terrible before that. So it's a little bit too active when it tries to uncover the stealth trends. It's kind of a new market regime, and when you combine these equity curves at the Cobra Euro 4 unduly penalizes it. But I hate to come up with one strategy that has dates in it with 2 different sets of rules. I don't do that. I don't change the sets of rules for different dates in my code. It's not very transparent, and it's a little bit misleading when you do that, unless you predicted it in advance. If you predicted it in advance, then you could, but to go back in hindsight and say, yeah, this is what we would have done, a little bit, I don't really like it too much. But at the same time, this trying to combine Cobra Euro 4 unduly penalizes it. So we may combine them, but make that as a note so that you are very aware of what was done to merge those 2 strategies into one, where Cobra Euro 2 was prior to 4 years ago and Cobra Euro 4 is 4 years forward. Or I don't know the exact date. So you just add all these strategies except for this one, because we have a 2020 version and we're not being redundant on this. We're being redundant on some of the stock index strategies, like we have 2019 and 2020 in the 38 system portfolio. So when you come here, you get a lower drawdown than you do on the 19 system stock index portfolio. This goes to 8407. You do have more swing trade strategies. Your largest losing day is much higher. But one of the things I want to show you is how nice the equity curve gets when you add that additional diversity, and how narrow these drawdown curves are. And so let's pull that back up. It disappeared. So I was trying to get the pin out. I think I can get the pin from a different location. So let's try this. Normal pin drawing mode. I'm getting a pin out. Pin. So see how narrow this one's the widest one. I need to change the color of that pin so that it's red so that you can see it a little bit better. So these drawdown curves are much narrower. The return to equity peaks is fast. So you see periods of time where it takes longer to recover, and then the periods of time where it's pegging the equity peak, pegging the equity peak. Takes a little longer to recover, pegs equity peaks. You know, these are fast moves, and you could, you know, the opportunity of this is you can wait for a drawdown, like right here. You can buy this dip in the equity curve, and essentially get the portfolio for the cost of the drawdown. You missed the drawdown, so you're getting in on a drawdown, and your cost is transparent to the drawdown. So, so those are the drawdown curve analysis. So Warren has a couple other questions. My email address is david@capstonetradingsystems.com. Easiest way is to go right here. Let me get rid of this pen. Let me get rid of all those marks on here. Erase all drawings. Go here and click on Contact Us. You can contact me. Here's my email address, david@capstonetradingsystems.com. Email me. For this setup, you can execute your own trades. I do have some offers, some potential offers to trade for you that I'm looking at under a managed account if you're a QEP, but email me and I will go over that as well. So depends on how new you are to trading, if you really want to do it yourself, or if you just want the potential results of this setup. So that's something that I'm considering offering. So email me, ask me those questions. Appreciate those questions. Those are good questions. So back to this, you see how quickly these drawdowns recover, much more narrow, and this is a preview of the 200K portfolio, all strategy access. So more diversity when you combine the 19 system stock index portfolio with all the other strategies I have in this spreadsheet, not including this redundant Asia Gold long from 2019 prior. We have the 2020 version there, and not including Cobra Euro 2 and 4 because of what we talked about already. So that's the upcoming webinar. I'll probably have that on December the 30th, Monday, a couple of days before New Year's, and a series of webinars into the new year as well. So have some books as well if you want to take a look more at the code. We've talked about some code on my website. You have the 7 trading systems for the S&P futures. These both have members areas with books with code you can download. If you're learning coding and you want to start learning how to code to develop your own strategies, have these are all on Amazon as well. And so, you know, if you buy it on Amazon and you think it's good, appreciate a good rating there as well. Feel like some of the Amazon ratings have been a little unfair, and one guy I guess criticized me because my 7 trading systems for the S&P futures did not include candlesticks. So I never offered to discuss candlesticks in the introduction. So it's not a big deal, but if you would like to purchase one of these books and give me a positive review, that would also be a good thing too. So all right, thank you for coming. The monthly results for the 200K, I'll show you that. I'll show you that here. Here is the, we looked at the drawdown curve and the equity curve. Here are the results. This is a new portfolio that was put together, so the performance is hypothetical. It's based on a lot of strategies that I've had, as well as some strategies that that are new, and the combination of these strategies is fairly new, and pretty much every year is a 6-figure year. Historically, I do expect degradation in the future. I don't expect future performance to be quite as good as past performance, and strategies do degrade over time, and so we get a little bit of a degradation, as we move forward, and then we adjust. We get some degradation, and then we adjust. So that is how we work. The best way I know is to put a portfolio strategy together, find out what's working in the past and what's working now, and then to go forward from there. So my throat is hurting at this point as a trader. I'm not used to talking this much. I don't know how some people talk all day for their jobs. Some people talk all day for their jobs. And a lot of respect for people that are on the phone all day. I would not enjoy that, not enjoy talking all day. I like to observe and trade and develop, but I do enjoy giving these webinars, and I enjoy having you here, and I appreciate everyone being here that was here, and I thank you for that. So some future webinar discussions as well will be over the mechanics of actually setting the webinars up. Here's my email address once again. Setting up the webinar, setting up the automation, going over synchronization failures. If you do get, it's important to be connected to the internet. If you do this on your own, have an exceptional internet or a VPS. Highly recommend a VPS if you do this, and you can get those. Because of the number of strategies, you need a larger VPS, between 150 and 200 a month. Or if you're going to babysit these strategies and you're comfortable with the internet outage, with the internet you have, and are able to know what to do if you have an internet outage, I'm going to go over that actually in another webinar. So if you do lose synchronization, you know how it's fairly easy, and I can show you too if you have that question when getting set up. So that is the stock index portfolio for 2020, 19 strategies, 38 strategies, and that is what I have today. So I'm going to take a break now. Email me with any questions. I really thank you for being here. If I don't talk to you in the next week or so, have a Merry Christmas, a Happy Holiday, and a New Year coming up. So don't know if I will get to talk to all of you before then, or if you will be on future webinars, but I hope it goes well. I wish you a prosperous rest of the year and next year, and I hope all is well with you. Thank you for coming once again today.